Did you know why renowned investor Cathie Wood has been purchasing stock during the decline with her company ARK Invest? When the price of the shares they own drops, most investors are concerned. It sounds like Wood has a different perspective, so you wouldn't want to miss this. Without a doubt, Cathie Wood has made timely trades, repurchasing shares as the market declined and selling some as it increased. In mid-October, Wood added 66,190 Tesla shares to the over 132,000 she had purchased earlier in the month, following Tesla's announcement of missed delivery. Yes, in the initial part of October, ARK Invest made their first purchase of the month. Wood's most recent acquisition coincided with the stock's decline after Tesla released its Q3 earnings and disclosed its delivery and production figures via a press release. Furthermore, a few days ago, Wood's ARK Invest filled its innovation, next-generation internet, autonomous technology, and robots ETFs with Tesla shares. The automaker's recent decline on Wall Street presented a buying opportunity for the company's three funds. During the second week of November, the next-gen internet and autonomous tech and robots ETFs gained 2,909 and 9,173 shares, respectively, while ARK's Innovation ETF purchased 27,594 shares. Get an additional $10 register and fund your account with any amount on Moomoo. This exclusive bonus is being offered in honor of Moomoo's 10th anniversary. Take a look at the following link. Moomoo is an excellent stock trading platform with a plethora of innovative, user-friendly capabilities. I believe it will be very beneficial to many of you, particularly if you wish to be more involved in your finances. Determine the best timing to buy and sell stocks, for instance. In the description below, there is a link. The aim of all investors, novice and seasoned alike, is to profit fully from the stock market and make confident investments. Growth investors base their portfolios on companies with solid financial standing and promising future growth. There are a few likely explanations for Wood's continued acquisition of shares during the decline. To start with, Tesla has grown significantly throughout the years. EV manufacturer Tesla has become into a dynamo. IC developer and technology, it has completely disrupted the EV market in a similar way to how Netflix revolutionized entertainment and Amazon changed shopping. With a market share of almost 70%, Tesla leads the battery-powered electric car sales industry in the US. The best-selling electric vehicle EV in the US is the company's flagship Model 3, the Model 3. After its 2010 IPO, Tesla has grown into a much larger company than it was at the beginning, even if it has managed to establish a reputation as the gold standard over the years. In October 2021, the EV King's market capitalization surpassed that of the combined values of legacy manufacturers such as Toyota, Volkswagen, Daimler, General Motors, and Ford as it crossed the $1 trillion threshold. The stock of Tesla, a Zacks Rank 3 company, has a growth style score and an at VGM score. For the current fiscal year, earnings growth is projected to be 79.2% year over year, accompanied by a 54.2% gain in sales. In the past 60 days, 8 analysts have raised their earnings estimates for the fiscal year 2022. From 6 cents to $4.05 per share is now the Zacks consensus estimate. Based on historical data, Tesla has demonstrated an average profit surprise of 26.4%. With 95.7% cash flow growth under its belt, Tesla is predicted to report a 177% cash flow expansion this year. Due to its great growth in VGM-style ratings, good Zacks rank, and impressive growth fundamentals, experts feel that Tesla stocks should be on investors' short lists. Despite price increases, Tesla also touts high demand for its automobiles. Tesla has been increasing its pricing, but the demand for its electric vehicles doesn't seem to be affected. Elon Musk's electric car company saw profits surge to $3.3 billion or 2.5 billion pounds in the first 3 months of the year, despite greater costs as buyers showed they were willing to pay more. Deliveries for the company increased by 68%, and they would have increased if not for bottlenecks in the supply chain. The company claimed that COVID limitations have recently forced the closure of its Shanghai facility. There has been a dramatic decrease in the wait times for new orders for select Tesla electric vehicle models. Others seem to be suggesting that the demand is decreasing as a result, but it seems like there's more to it than that. Industry observers have seen a notable decrease in Tesla's delivery wait times in recent weeks. Recently, Tesla was charging up to 6 months for the delivery of several models. Nevertheless, those same cars are now listed as available in weeks. According to sources who spoke with Electric, Tesla is not having any problems with demand nonetheless. There are differences between its order book and production allotments for specific models of its cars, which is creating some opportunities for expedited delivery, particularly toward the end of the quarter. Tesla's direct sale business model means that up to the point at which customers own their cars, the firm is accountable for them. Since a car dealership does not handle the inventory, Tesla is responsible for maintaining a low level of inventory and matching production to demand. Wait times may fluctuate due to differences in the demand for different models and the production capacity of each model. To clear its massive backlog, Tesla has even ceased accepting new orders for certain models. This week, Wall Street analyst Pierre Farag of New Street Research, who covers Tesla, sent a letter to his clients cautioning them not to interpret the decline in wait times as a decline in demand. Don't react too quickly if wait times suddenly decrease. Wait times will continue to be unpredictable despite orders growing steadily due to erratic increases in production capacity. Even while suggestive wait times have decreased, our analysis unequivocally indicates that orders are reaccelerating this quarter. Wood continues to purchase Tesla stock despite the market downturn because the firm intends to boost battery output, which is positive for the business and, consequently, its stock price. As per a report published in August by the Japanese media outlet Nikkei, Panasonic plans to boost its manufacturing of electric vehicle batteries for Tesla by 10%. By 2024, Panasonic Holdings hopes to increase output of the batteries it provides to Tesla by roughly 10%. The Japanese business declared in July that it would also construct a second electric vehicle battery plant in Kansas, but the facility is not anticipated to start production until at least 2024. With a large number of engineers, Panasonic already produces batteries for Tesla at its Osaka facility. According to an executive, the corporation intends to transfer know-how to improve the production efficiency of its U.S. plants to the level of our home manufacturers. Additionally, it was revealed in the middle of September that Tesla is assessing whether it would be feasible to construct a battery-grade lithium hydroxide refining facility on Texas Gulf Coast in order to assist the manufacture of batteries for electric vehicles. According to Reuters, the automaker stated in a letter to the Texas Comptroller's office that it intends to construct the facility, which it bragged about as the first of its kind in North America to transform raw ore material into a viable state for battery production. It is anticipated that truck S&R rail will be utilized to transport lithium hydroxide, a crucial component of EV batteries, to the many plants that manufacture Tesla batteries. Recall that as lithium prices rise, Tesla CEO Elon Musk hinted that the business would go straight into large-scale mining and processing. Upon clearance, the business intends to begin building on the lithium plant by the end of 2024, with commercial production expected to begin in the fourth quarter of 2022. Compared to the traditional method, Tesla's new factory will employ cutting-edge procedures that require less dangerous reagents and produce usable byproducts, according to Bloomberg News. When automakers try to secure the supply of lithium, which has seen a price increase this year due to growing demand from the sector, Tesla may be the first in the industry to directly participate in lithium refining. At its current Gigafactory Nevada, which it jointly owns and manages with Panasonic, Tesla produces batteries for its electric vehicles and energy storage goods. Additionally, the business intends to start producing batteries at its recently constructed Gigafactory Texas, which is situated just outside of Austin. Tesla's profitability is a compelling factor for investors such as Wood to put money into the EV company. Despite being outsold more than 7-1, Tesla made 8 times more profit per vehicle in the July to September quarter than Toyota Motor, according to a Nikkei report that was published in early November. According to a Nikkei study, this is the first time since the American electric vehicle producer went public in 2010 that it has led in quarterly net profit. During that quarter, Tesla announced a net profit of $3.29 billion, using an average exchange rate of 138 yen to the dollar for the period. Toyota made 432.2 billion yen, or $3.15 billion. The market leader in electric vehicle production announced a third quarter profit of 3.3 billion, up from 1.6 billion in the same period last year, and almost matching the record profit it declared for the first 3 months of the year. From $13.8 billion to $21.5 billion, it recorded revenue. Elon Musk, the CEO of Tesla, predicted that his firm may overtake Apple and Saudi Aramco to become the most valuable in the world in his signature promotional style. To get more content about Tesla stocks, subscribe to this channel.